Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have the Econ Show. We have a lot of stuff to catch up on. So we're going to try to pick through what we think is the important pieces over the last 2 weeks, just because we didn't have our show last week, and really kind of hone in on what are the key drivers going forward. And the first segment, we're going to kick off of how the US dollar isn't going anywhere. It just isn't. You know, it's not even losing its prowess in the market. It's actually increasing. It's actually being used more often now than last year, and even over the last decade for transactions. And we want to look at, okay, if the yuan is really going to become a bigger piece, who or what is it displacing? Because it's not the dollar. And I think that's the important piece when we go forward to look at some of those different shifts. Then we're going to look at the fixed income versus equities, because fixed income is telling us that there's a problem and equities are just hanging out by the beach somewhere. And we want to understand who's right. Where are they both right in different ways? Where are we seeing some of these pressure points, and why is the equity market ignoring it? Then we're going to talk about in the third segment about core inflation and how that's still a problem and how it's not going away. And we're going to compare it to different pieces. How does it impact in wages? And then as you bleed down, what is happening with real estate? Because some of the numbers had gotten a bit better, and then the most recent data that came out today was actually pretty terrible. And how do those things interact? Then we're going to look at inflation in the EC in the euro region continues to be a problem. How the ECB is going to have to raise rates and slowdowns continue. And then we're going to wrap up with unpacking the Chinese GDP data, because it's a conundrum in its own right, because there are some things that happen, but then, or the numbers that happen separately that are reported month over month, year over year, show slowdowns, but yet the impacts into GDP were positive. So again, there's a lot of things to really go look at, and some of the growth could have been very much centralized or localized within the country. But then what does that mean for the sustainability of their turnaround? So when we turn to the kickoff segment one, we want to look at the IMF. And for those that have been following us, you know that we've thought the IMF expectations were lofty. Global growth estimates have been revised lower by the IMF. Not surprising. We still think that they're still lofty for 2023 and 2024, but at least they're getting closer to those levels. And most major economies expected to see GDP growth slow this year. Notably, the U.S. expected to fall to 1.6% this year, then to 1.1% in 24. And I think that's the key piece. Now, for anyone that watches, that's been watching this, we think inflation's a bigger issue. We think raising rates are a bigger issue, and that growth is going to slow in 2023 further and be well below that 2.8% level. But it's important to look at the setup between 23 and 24, because that we do agree with, is that this is going to be a longer slowdown. We're not going to get this week 2023 and then this massive increase. Everything's robust and healthy and strong again in 24. It's just there's going to be a lot of this prolonged pain, which I think is something that the market is not really expecting. And I think when you always hear people, it's like, oh, they're looking through 23 to next year. It's like, well, next year isn't that great either. And for those that know me and what we've talked about, we think these are still overstated, but at least moving closer to in that right direction. And here's some of the reasons why. And we when you look at the global CPI diffusion index, so the percentage of countries with CPI in an uptrend, and that's a sizable number. So it's no longer 100%, but it's still 95%. And that, again, is the problem that we continue to see. And if you think about it, this is before OPEC cut production again. There is a lot of that stickiness in that inflationary level, especially if you consider the U.S., which is a natural importer of goods. We're going to be importing this inflation. So global median CPI year over year, you can see has come down a bit, but we are not normal, and we're not in a normal situation. And when you look at this data, we're not really even moving towards normalcy. And that's why when you look at the slowdown, and these are things that I think, well, and to the IMF's credit, these are things that are hard to calculate of like, well, how is inflation going to impact this? It's all estimates. Those all sensitivities. And our view is that wages are weakening faster. Savings have been deployed. And now governments are struggling with how do we continue to support and give some sort of subsidy as their balance sheets get stretched, which is why the limitation on stimulus is going to create more slowdowns, more problems, and keep those rates moving higher. Now, the sticky global inflation will keep a handle on global liquidity. So when you look back in terms of the global financial tightness, you can see that there's still a lot of tightness in the region on the global level. And that just means that it's more expensive to lend, it's more expensive to borrow, you're not going to get the capex that you were expecting, investment's going to slow. And these are the problems that we continue to see. And when you look at it in general, when at advanced global financial tightness indicators, so not only it's not only bad, but it's also going to get worse. And after a little bit of that reprieve, and one of the things that the reason why that's the case, and what we've been saying for those that have been watching us, is that the whole goal of the central banks at this point is to take liquidity out and try to do it in a very controlled level, which is why we've been saying that the credit the credit was going to slow, and that multiple level, or the credit indexes were just going to kind of go sideways, and you were going to see this chevron pattern where you weren't going to get this churn of or if you want to think velocity of money, you were going to get some of this slowdown that was going to create some of this pullback. And it's one of the things that we continue to see, which is why when you start looking at investors expecting a stronger economy in Asia Pacific, even ex-Japan, even that's coming down. And you're starting to see investors expecting a stronger economy diminishing. And you're seeing less and less of where people are looking at this and saying, okay, well, based on inflation, rates are going to keep going up. As rates keep going up, it's going to be harder to borrow. If it's harder to borrow, you're going to have less spending. Then if you have less spending, you're going to have wages and investments that are going to slow. And that's where you see this perpetual problem. And I think this is an example of it. Then you look to, the central bank outlook, and rates will be higher. And there is a view in a lot of these key areas that rates are going to continue to go up. It's mixed, but rates are going higher, and especially when you look at the ECB. But one of the things that I wanted to point to is China, because there's still a view that China is going to ease and stimulate. But if the GDP numbers are real, why would you stimulate? Why would you cut rates? Like, there's no reason to cut rates. Inflation, when you look at it, retail sales surged, but yet inflation was down. It's like, okay, well, which is right? Is because if retail sales are going up to that level, you should see inflation going up because prices are going to go higher. But they didn't; they came down. So what is the tell? And that's why we just think that China at this point, or the PBOC, is just going to sit sideways and say, look, we need to figure out and let some of this play out before we can give an indication on which level we're going to go, which is why we think things are going to be very stable on a rates level coming from the PBOC. And another key piece is we start looking at the shifting geopolitical patterns. India has overtaken China as the world's most populous country. Now, it's a good and bad thing for the nations, but India's younger demographics could support a stronger potential growth over the next several decades. But again, mismanagement is always a risk, but it's an interesting backdrop, because if you look at some of the different shifts in the spending patterns, we've seen India more willing to spend versus the Chinese populace. When you look at the local consumption, you look at the different shifts in general, and India, throughout the last 15 some odd thousand years have been a friend of the West. And that is something that is going to be an important point as we start talking about the US dollar, because, okay, India and China are in BRICS. India and China are shaking hands. India and China historically do not like each other. Now, if you're India, are you going to want countries to transact in yuan, or do you want them to to do business in dollars? And that's where we continue to see there's a lot of reasons that India will want dollars versus others. It's another key component because when you look at the issues in Latin America, for those that have been doing economics as long as I have, several nations in Latin America have gone bankrupt on more than one occasion over the last 20 some odd years. So in order to also get around this and to try to protect against inflation, which has run rampant at different times, you're not allowed to transact or take currency out of the country. You can operate in forwards, which is how you would get exposure or protect or hedge yourself when you're looking at Brazil and some other areas. But it's going to be difficult for local countries or local economies to transact in reals if you can't actually take them out of the country and you have to leave them in there and then have your own level of economic prowess there and you're living in the local currency, but you can't actually repatriate out, which creates problems, which is a way for the dollar to get around that. And that's where you continue to see these things. And when you look at the trajectory for India, China, who is going to have more weight going forward? Who is going to demand more crude going forward? When you think about where these commodities and raw materials are going to go, India's in a very good position and they're a bit more friendly, if you will, to potential trade partners versus China, which is, some of the policies have been called, walk like a tiger and trying to be, tough on things and trying to I don't want to say force, but be aggressive with some of the negotiating tactics. But a lot of those negotiating tactics when I was doing this as well was that China was growing. There's a great local community. There's a great local middle class that's only going to grow and it's going to demand goods. And you're looking at it, it's like, well, that never came to fruition where you did get a middle class, but spending didn't really come to the degree that was expected. And now there's a new kid on the block and they're a bit more friendly when it comes to deals and to working. And so again, this is why I think there's a pause, in my opinion, of where the dollar is going to go. So then when you start looking at the non-bank financial intermediaries are nearly half of the global financial system. So if you're a non-bank financial individual, what is it easier to deal with? Is it easier to deal in dollars or is it easier to deal in yuan? Is it easier to run? And again, from China's perspective, if you have the yuan or renminbi at an increasing degree, you're going to have to give up your account surplus. So are they willing to give up that kind of power? Somebody was saying that, China could just sell down treasuries. It's like, okay, so if China sold all of their treasuries, which, I think as of recently, that's about 900 billion, what is supporting the Chinese economy? When you look at the fact that the assets they have on their balance sheet have been leveraged multiple times, they've been promised as collateral in different levels. Well, those treasuries are backstopping and are acting as collateral. And now China did something fun. They not only used the principal as collateral for one thing, but they used the interest and cash flow as another. So you've collateralized the treasuries twice. So that means that if you sell that treasury, you now have to replace that collateral in some shape, way, or form. And dollars are still a dominant force when you look at trying to manage expectations from an inflation perspective and securing global trade. And besides the fact that China is still who's the largest trade partner but the U.S. So again, could they sell down all of them? Sure. But it's a plan of mutual destruction, which is why we don't think it's a likely scenario. Now, the size of monitoring aggregate and compensation of the narrow measure ended as of 2021. So total financial assets are about 486.6 trillion. Now, what about when you start adding in derivatives? And again, notional value of the derivatives. You're actually coming to close to $1 quadrillion And I know that number sounds crazy, but you're looking at a massive number of financial assets and as well as the derivatives on those financial assets. And you'll be surprised to know that hundreds of trillions of that are denominated in dollars. So not only is it just the transactions are in dollars, the trade is in dollars, but also the derivatives and then the insurance on the derivatives and the insurance on the stuff that is moving is all in dollars. That's not something that is going to be replaced easily, let alone in the next decade or 2 decades. And one of the things for those that have been following us, because I actually did a USD dynamics show back in 2020, was that the dollar was going to survive this round. We're going to have a Bretton Woods 3.0. We're going to have some sort of new agreement, but the dollar's not going to lose ground. I think other things will lose ground, and that's when we start looking at some of these key areas. So global real estate assets relative to other asset classes, as you can see, residential real estate and commercial real estate are a massive piece of it, especially residential. So when you start looking at the exposures to banks, especially in international areas because if you look at the G20, the US's increase in home prices, which for us sitting here is shocking, is actually quite low in comparison to other areas, including New Zealand and Australia and the UK. So there's a correction coming or it already happening when you look at most areas also don't have 30-year fixed rate mortgages. They have adjusted rate mortgages or ARMs, where you're seeing this play out, and that's going to put more pressure on banks. And banks have to show collateral. They have to show liquidity. Is it easier to go out and find dollar liquidity or yuan liquidity? Where are you going to get your ability to support? And again, these are things that are difficult to really come down. So that brings it all together. And look at the US dollar, euro, yuan, British pound, Japanese yen. The share of international transactions from 1989 to today, to 2022. When you look at it from 2010 till 2022, so over the last 12 years, the international transactions of dollars have gone up, not down. But when you look at euro, when you look at Japanese yen, that has gone down. So what is really being replaced? Is it the US dollar or is it a European asset and other Asian currency? And I think that's the key piece. When you look at some of these flows, it's like, okay, euro peaked in about 2010. And in 2022, they've lost about 10% of their exposure. You look at Japanese yen, peaked in about 2013 and has now lost about 10%. And then you look at yuan, which has gone from the nothing in 1998, really looking at 2010 to today, which is still less than 10%. So again, who is losing clout? Is it the dollar or is it other currencies that nobody wants to transact in to these levels? And that's a way of placating China, but not actually taking it or eating into the Chinese share, the US share. And then you look at, okay, China's goods trade settled in renminbi in Q1. Its share of total goods traded between 2011 and 2023. It's a sizable number. It's not what it was in 2015, but it is a bigger number. But the question, again, comes back to what is being replaced, and it's not the dollar. And I think that's the important piece here, especially when you start looking at the share of export invoicing. When you look at the share of export invoices, so you look at the Americas, back to our point about the inability to move these currencies easily, almost 100%. This includes Latin America. That's North America, South America. Almost 100% of export invoicing is in dollars. Asia Pacific, 75%. Europe is lower. Why? Because if France is transacting with Germany, they have a currency for it. It's like North Dakota transacting with Minnesota. We have a currency for that. And then you look at the rest of the world, it's still almost 80% is the US dollar. So again, there's not this huge shift. Like the US dollar dominates international commerce except in Europe. Invoices for exports are decisively denominated in dollars across much of the globe. And then the insurance against it, and then the derivatives against it, then the hedges against it, which are part of the derivatives, are all in dollars. Most of the debt supporting it is in dollars. It's going to be difficult to do that, which is why when you look at foreign exchange reserves, you've seen a flat line and now a small increase in dollars. Why? Because dollars is a stable currency, relatively speaking. Again, just for what we're talking about here, and you've seen this flat line. And realistically, what is going to be replaced? Is it going to be the yen, which is becoming more and more funny money by the moment, or is it going to be British pound? Is it going to be the dollar? And again, the renminbi is going to be there. But we believe it's going to take Japanese yen's place and not the dollar's place in general. So then you start looking at the different levels of, okay, well, where are some of the rare earths? And this is when we look at what does that 2.0 look like, 3.0 look like in Bretton Woods. And one of the things that we've talked about is countries that are commodity heavy, that have a lot of commodities that they could backstop some of their currencies with. And global rare earths is going to be an important piece. And when you look at it, the top three are China, US, and Australia. And China is willing to use that as a bargaining chip, which is why as much as China and the US are coming at odds in different ways, there's also reasons that we have to maintain some sort of frenemy status until someone blinks and we get pushed over that line, which will happen in our opinion over the longer term. But again, or realistically, is there more of a internal strife within China, some sort of civil war or some sort of adjustment, if you will, which is something that Xi, if you look at it and kind of read between the lines, is something that he's actually concerned about. But we'll talk about that more in the last segment. But rare earths are becoming a bigger and bigger part of today's society. EVs, green technology, all require a large part of rare earths, which is dominated by China, which is something that we have to pay attention to. But in the meantime, when you look at PPI freight across the world, truck, sea, air, it's starting to move down, and that's where we start looking at freight and in general, based on deep sea water, on trucking, on rail. We see some of these declines continuing, which again is going to be good for rates, good for inflation in that piece, but it's showing that there is a crack in the underlying demand structure. And here's just another example with demand indicators here, looking at view of demand the next 0 to 3 months. Demand indicator is contracting, rate indicator also showing contraction, which is why when you start looking at it and you look at, it's like, okay, that's a good piece in terms of global inflation coming down. But now look at agriculture commodities versus food prices, because the UN food price in agriculture is showing one thing, but the Bloomberg index is showing something very different. And it's you can see that they typically move together, but sometimes there can be a lag. And this is one where, again, neither of them are right. It's going to be somewhere in the middle, but it just goes to show you that some of these big things that have been talked about and highlighted as like global food prices have fallen by nearly 21% from all-time highs, drawdown not worse seen in prior recessions. So even though it's come down, it's still at near all-time highs. And now if you look at the basket of current futures and the curve, you're actually seeing this reverse back up. So again, that's going to put another round of stress on the underlying global population, global populace, when you look at inflation or stagflation, really, because this is where when we talk about inflation, deflation, disinflation, our view has always been stagnation, and you're going to get commodities where even if demand comes down, you're not going to see commodities fall because of that supply issue, or they're not going to fall to the same degree that they should given the level of a recession. And food is going to be a big piece of that, which is why we're so concerned and why we focus so much on food and the problems there. So that's what we have for you on the global side and the support of the US dollar. The next segment, we're going to go deeper into the US and what we're seeing with some of the issues between what the fixed income market is telling us, what the equity market is telling us, and where do we shake out in terms of who is right.